If you've got a trust, a holding company, or any offshore entity, there are 4 signs that what you think is tax planning is actually tax evasion. My team and I review structures like this every week, and most people have no idea that they're actually committing tax evasion. So in this video, I'm going to show you exactly what these 4 crucial signs are, how to check if your tax structure has them, and how to fix it before the tax authorities come after you. Picture this: a health professional, let's call him Dr. S, walks into his accountant's office. He has built a successful practice, good income, growing family, and a tax bill that makes him sick every year. His accountant says, "You need a trust." So Dr. S pays the fees, signs the documents, and sets up a family trust to hold his assets. He's told that this creates separation. His wealth is no longer his. It belongs to the trust. He sleeps better at night because he thinks that he's protected. Fast forward 2 years and the tax authorities open an audit. They look at the trust and they ask one question: who controls this? Dr. S set this up. Dr. S is the trustee. Dr. S is the beneficiary. And every decision is clearly made by Dr. S. So the auditor closes the file and says, "You settled this, you're the controller, you're the beneficiary, so this is a sham trust." Immediate freeze on all bank accounts, re-review of all of your previous tax returns, and charged with tax evasion. And just like that, every dollar that Dr. S thought was protected is now fully exposed, taxed, penalized, and a criminal investigation launched against him. Here's what Dr. S did not understand. A trust only works if there is genuine separation. You cannot be the person who created it, controls it, and benefits from it. In fact, the more roles that you have, the weaker the structure becomes. A compliant trust needs independent governance, trustees that aren't you, documented decisions that prove that the trust has its own mind and management, not yours. This is why properly designed structures use a trust in a jurisdiction with very strong trust law and independent oversight. Those trusts operate separately in a different place with different people that make the real decisions. If you do not compliantly document that that trust has its own mind and management, then the tax authorities have every right to investigate everything attached to it. So if you set up the trust, you clearly control or manage the trust, and you benefit from the trust, it is a sham, and the tax authorities will ignore it completely. And you will pay full tax plus penalties and open the door for criminal charges against you, just like this happened for our client. Now, if this first sign is already sounding familiar, then there's a link in the description to book a complimentary structure review with my team. That alone could save you a shed load in tax and tons of stress. But keep watching, because sign 2 is even more common, and it's the one that gets people into serious trouble. Same guy, Dr. S. His accountant had another idea. Set up your company in the US and pay yourself consulting fees. That way the money sits offshore, outside the reach of your home country. Sounds pretty smart, right? So Dr. S creates a US company. On paper, it provides marketing and consulting services to his medical practice in Canada. Every month, $16,000 flows from his practice into the US company. $16K every month for marketing and consulting services. That US company, it's got no employees, no office, no clients, no operations, nothing. It's a bank account with a logo in another country. So when the auditor asks, what services does this company actually provide? Dr. S has nothing. No invoices, no contracts, no deliverables, only wire transfers for $16,000 a month. So this company exists for no other reason than for Dr. S to avoid taxes in his home country. So the tax authorities did not see an international business. They saw a health professional sending money to himself through a shell company, and they have a word for it: tax evasion. A company in another jurisdiction only works if it has real economic substance. That means actual employees, actual services being delivered to real clients, real market invoices, and at least a real office, not just a PO box. And if money is flowing from your home country business, you need transfer pricing documentation, proof that the fees are what an unrelated company would actually charge for those real services. This is called arm's length pricing, and it is very important to have, otherwise the door is wide open for investigation. A proper international structure uses an operational jurisdiction, so a place where real business happens with real banking, real transactions, and real purpose. But if your international company is just a bank account, in another country, the tax authorities will look straight through it. And everything that you thought was offshore becomes fully taxable, plus penalties if you haven't documented it properly, which almost nobody does. So the second sign that you're committing tax evasion is if your offshore company has no employees, no clients, no real operations, it's not a business, because it has no substance. It's just a wire transfer with extra steps. And to the tax authorities, it is evidence that you are committing tax evasion. Now, here's where it gets even worse. Even if you fix sign 1 and sign 2, even if you have a real trust and a real company, sign 3 can destroy everything. So let me ask you a question. Every time that you move money between your entities, so your business to your holding company, from your holding company to your trust, from your trust to your offshore entity, is there a real invoice for each transaction? And are those invoices real? Not just a bank statement, an invoice, an actual invoice describing an actual service at the market rate. Most people don't have this, and they don't realize that this is a problem until it's too late. I spoke to someone last month who had a beautiful structure. Trust, holding company, offshore entity, all set up by a reputable firm. And for 3 years, money flowed between these entities for management fees, consulting fees, administrative fees. Then the audit came. The auditor asked to see these invoices. He asked for the service agreements. He asked for proof that something, anything, was actually being delivered. The client had nothing, just bank transfers, just labels on wire transfers, no actual paper trail. The auditor didn't need to prove tax evasion. He just needed to show that the client couldn't prove compliance. So 3 years of tax savings, gone. Full tax, 50% penalties, interest, and a file that is now flagged for the next decade. All because of sloppy documentation and cutting corners. Every transaction between entity needs 3 things to be compliant. 1, a service agreement. What is being provided, by whom, and for how long. 2, invoices, real invoices, with descriptions, dates, amounts that match the previous agreement. And 3, proof of delivery. Evidence that the service actually happened. Emails, reports, deliverables, something tangible. And this is called transfer pricing documentation. It proves your cross-border transactions are priced the way that they should be, between unrelated companies. A proper international structure builds this from day one. Every transaction is documented. Every fee is justified. Every payment is completely defensible. Without it, you're not running a structure, you are running a risk. So sign 3, if you can't produce invoices, service agreements, and proof of delivery for every payment between your entities, the tax authorities will launch an investigation because you failed the transfer pricing test. And the excuse of, my accountant set this up for me, that won't save you. Now, sign 4 is the one that catches almost everyone, and it's usually invisible until the audit letter arrives. So let's go back to Dr. S one more time. He had a trust, he had an offshore company, he even had some invoices. But when the auditors mapped out the entire structure, they found something interesting. The trust, Dr. S was the trustee. The holding company, Dr. S was the sole director. The offshore company, Dr. S was the only shareholder. Every board meeting was Dr. S talking to himself. Every decision made by Dr. S. Every signature is Dr. S. On paper, it looks like 4 different entities in 3 different countries. In reality, it's one man playing 4 roles, pretending to be a structure. So the auditors didn't see an international business empire. They saw a fake setup with the sole purpose of avoiding tax, and they called it failing the control test. And when you fail the control test, the tax authorities don't audit your structure. They ignore it. They collapse every entity back into you as an individual taxpayer. And they tax everything, every dollar, every transaction, every offshore payment, as if the structure never even existed. So Dr. S didn't just owe back taxes, he owed penalties, interest, and now his file is flagged. Even his professional license as a health practitioner is at risk because tax evasion is a felony. All of this because he thought that having entities meant having separation. It doesn't. Control matters. And he demonstrated that he controlled everything. A real structure requires real separation of control. That means you cannot be the only person in every room. Someone else needs genuine decision-making authority. A board, a trustee, a foundation council, just people that aren't you. This is why sophisticated structures Use a governance jurisdiction, a place with strong legal frameworks for independent oversight. The entity's mind and management sits there. Decisions are made there and documented there. A proper 4-jurisdiction structure separates 4 things: where you live, where operations happen, where governance sits, and where ultimate ownership is held. Each layer has its purpose. Each layer has its independence. And this is what makes it defensible. That's what makes it real. If you're clearly the puppet master of every entity, you don't have a structure. You have a liability, a dangerous and expensive one. So sign 4. If you are the owner, director, trustee, beneficiary, and decision maker of every entity in your structure, you've obviously failed the control test. And the tax authorities will treat the entire structure as if it doesn't exist. So those are the 4 signs: sham trusts, shell companies without substance, incompliant invoices, and the control mistake. But this next part is what most people miss, and this is critical. If you have watched this video and you recognized your own structure, your instinct right now might be to fix it, to build something new, build a better trust, a better company, a better structure. Don't, because here's what most people get wrong. You cannot fix a broken structure by building a new one on top of it. You have to clean up the past first. That means unwinding what is broken, filing disclosures that you should have filed years ago, correcting past reporting, getting compliant with what you've already done before you build anything new. Otherwise, you're just adding another layer onto a house with a cracked foundation. And when the tax authorities come, and they will, the whole thing collapses. This is the #1 mistake I see most often. People panic, they build, and they make it worse. Clean up first, then rebuild properly. That's not advice, that is the only way out. So now you know the 4 signs that separate tax planning from tax evasion, and how to check to see if your structure has any of them. But here's the thing, knowing what's wrong isn't enough. You also need to know what right looks like, because the wealthy don't just avoid mistakes, they build structures that actually work. Real governance, real substance, real separation, and they do it without relocating. If you have recognized any of these signs in your own structure and you want to know exactly where you stand, there's a link in the description to book a complimentary structure audit with my team. We will review what you have, identify the risks, and show you exactly what needs to happen next. But if you'd like to understand how compliance structures actually work, how the wealthy reduce tax legally, transparently, without leaving home, I made a video breaking down the 5 ways that they do it. I'll show you exactly how they separate operations from ownership, how they document everything to stay defensible, and how one client, David, went from losing half of his profit to tax every year to operating compliantly across 2 jurisdictions with total clarity. Click the video on screen now to watch that next. And remember, stay sovereign.